House prices are undervalued, at least according to serviceability. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, and frankly, I thought we should have a look at this article from Mortgage Business because I'm interested to see the tale they're weaving here. House prices undervalued, going off mortgage serviceability. Okay? From InvestorKit. House prices in 6 out of 8 Australian capital cities are undervalued, according to a new analysis of local households' ability to repay their loans. There you go. So they're undervalued. Is it the deposits that's keeping these properties down, or maybe fear of interest rates going up? The report from buyer's agency InvestorKit has analysed housing affordability through the lens of home loan serviceability, the ability to make repayments on a mortgage. It has calculated the percentage difference between the median house price and the affordable house price across each city, based on the average local wages for a dual income household and loan affordability of 30% income. Okay, so I'm assuming that's 30% gross income that's sitting right on mortgage stress. And notice here how they've got a dual income household, which is really good that they're actually drawing attention to that because, well, these days you need a dual income household. And when they're talking about house prices and particularly referring to, times in the past, they need to compare the housing affordability to household income. Households these days, you've got 2 people earning 6 figures, you've got more disposable income than back in the day when it was 1 person working. Imagine that. You could afford a house, a family, a holiday, good quality of life, all on 1 income, and keep your partner at home, managing the household and raising the family. Wow. Don't get me wrong, that still happens, but it's more of a luxury. All the people that do it make sacrifices. They're not running off and buying multi-million-dollar houses in Sydney and then bitching and moaning to the newspapers that they're unhappy. Back to this. InvestorKit calculated the maximum house price of an affordable home loan repayment for a 3.5% interest rate as well as for 4.5% rate, allowing for a potential cash rate hike. Only Sydney and Melbourne house prices exceeded the affordability threshold. However, InvestorKit founder and head of research, Adrian Paliwal, commented that while the remaining capital cities are affordable, cash rate movements could shake that up. Cash rate hikes would affect housing affordability to a large extent, particularly in the ACT, where a 1% rate rise would see house prices shift from affordable to unaffordable, he said. Fortunately, the RBA recently indicated that there would not be a cash rate increase in 2022. Good news for home buyers planning to enter the market in the coming year. Sydney was found to have the most overvalued prices, with the median house value sitting at $1.1 million, exceeding the calculated available median price by 3.5% interest of $862,000. According to InvestorKit, the Sydney property market is overvalued by 22.3%, meaning that prices there are much higher than the average household can afford. Well, Sydney isn't for the average household anymore. Times are changing. If home loan rates were to rise by 1% to 4.5%, the market would exceed the affordability level by a third at 31.2%. Meanwhile, the Melbourne median house price of $818,000 exceeded the affordability level by 2.8% at a 3.5% interest rate. At 4.5% interest, the market would be overvalued by 13.9%, with the maximum affordable price being $795,000. The median price in Canberra was $826,000, 6.6% below the affordability threshold. But if interest rates were to climb by 1%, houses would become 5.6% higher than the average dual income household could afford. Brisbane's median house price was $603,000, 29.6% lower than the affordable median price at a 3.5% interest rate. Well, yeah, Brisbane housing is affordable, everyone. Still, depending on where you look, you can get a decent house for a reasonable amount of money where you don't need to have that much of a stressful mortgage. Perhaps that's why we're seeing a lot of the Southerners move to Brisbane, sell out, get better, more space, better quality of life, better weather, and opportunities now to work remote. If interest rates picked up by 1%, Brisbane would still reportedly be undervalued by 14.8% below the affordability level. However, the city is expected to see strong growth in 2022, carrying on high interstate migration from past year. Similarly, InvestorKit has forecast Adelaide will also see strong growth in the coming year. Adelaide's median house price of $526,600 was 42.8% below the affordability threshold and 26.5% lower at 4.5% loan interest. The most undervalued city recorded was Perth, with a median house price of $510,000, 63% cheaper than the maximum price a local household could afford, and 44.7% lower if interest rates rose by 1%. Hobart's median house price of $595,000 was undervalued by 18.3% at 3.5% interest. If interest rates rose by 1%, median house prices would be 5% lower than the affordability threshold. Although house prices weren't as high as other cities, Hobart had the lowest average personal income, with affordability likely to slip for locals if lending rates are raised. In contrast, the Northern Territory's capital had the highest personal income level combined with relatively low house prices. Darwin had a median price of $550, 61.3% below the affordability level and 42.8% below if interest rates were to 4.5%. InvestorKit found that Darwin's sales market to be the highest in a decade. The sales market is so active that both listings and sales volumes are increasing steadily, he said. Many are trying to use this boom time to get out, in our opinion, as listings don't rise at this rate when boom conditions typically occur. So there we have it, everyone. Are house prices undervalued? What do you think? Let's have a bit of a talk. Now, this is very interesting, the methodology that he used, just based on serviceability. And because many have said serviceability is a lot easier than actually getting into the mortgage, guys. It's the big deposit. That's the real hurdle that a lot of people struggle to get over. So even if we start to see these increases in interest rates, I think we'll see a bit of pain in Sydney and Melbourne, but not the calamitous huge crash that many people are begging and waiting for or predicting. I think it may stagnate a bit, but it won't be uniform. What do you reckon? Makes perfect sense, even with an increase in interest rates. I mean, how many people are paying such low interest rates now that, have you done the sums, if we're going up to 4.5% or 5%, what you'd be paying, if you'd even have any issues with it? I'd suggest you do it now, guys. Check it out. Thanks for watching this episode of HeiseSays, and check out this video I did yesterday, why it's harder for millennials to buy a house, everyone. And then compare and contrast it to what we just saw today. And let me know your opinions down below. Take care. I'll see you all next time. Bye for now.